Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Welcome, everyone. This is Steve Meisinger, your host for today's ISE webinar. I'm pleased that we have Jack Crooks with us today. Jack will be talking about capitalizing on the U.S. dollar bull market. Jack is the president of Black Swan Capital. He's been in business for over 20 years, really looking at the markets in an advisory role. And he'll talk about what his view of the dollar versus the major currencies. He'll give us some possible scenarios on how this might all play out. And please, you can also go to blackswantrading.com to learn more about Jack's services. He and his son write a newsletter each and every day. It's a paid newsletter. It's called Currency Professional, and I'd urge you to go and check it out. Jack, thanks so much for joining us here at the IC. I really appreciate it.
Steve, thanks for having me. I appreciate the opportunity.
We're really looking forward to it. Yeah, sorry.
No problem. As Steve said, I'm just going to go through today and really give a view that we've had for a while, actually. We started in November, December with this view on the U.S. dollar. And it appeared by the price action that we were very right, but the reality is there's some question marks even in our long-term dollar view, and we're going to talk about those question marks today. But overall, we're still cautiously bullish long-term on the U.S. dollar, and we'll get to those reasons. And as Steve said, there are obviously some takeaways here in terms of what the trades are, and I'll give you our favorite one there and some others you can look at. And as Steve said also, I'll try and get through the presentation as quickly as possible and have it still make sense. And please just fire your questions in, and Steve and I will get to them afterwards. I also want to say and just kind of reiterate a little bit of what Steve said in terms of trading. Our types of ideas, we're not short-term traders, and I think there's a lot of very good short-term traders that Steve has in here, and very, very good short-term technical guys that do it a lot better than we do. But in general, I preface that by the reason I say that is I think this product that they have at the ISE really does lend itself better to intermediate-term trading anyway. Looking for the trends, and we try and use the fundamentals and the technical setups together to try and catch those trends. Even what we consider our shorter-term trades tend to be multi-day affairs if we get it right. And even using these options for multi-day trades or multi-week trades, I think is really the sweet spot for these things. And you can discuss that more with Steve. That's why we like them we like these types of options for our fundamental setups. We think it particularly fits them very well. Here's a look at our disclaimer. That's ours. The first one was Steve's. First of all, this is a look at really the ISE FX options product. The key, it's accessible for your online broker just as your stocks would be. This stuff trades, and the strategies are just as you would with stocks. They've made it look like a stock option. Everything's exchange listed. Everything has complete transparency. It's dollar settled, European style exercise. That doesn't mean you can't buy and sell at any point in time. That just means you can't get exercised along the way till expiration. And as bullet point here is can be traded as spreads, and you can do all kinds of things in here that, as I said, you can do if you're familiar with options at all. There's no difference here. The only difference is the underlying. The underlying is the foreign currencies, and hopefully I can shed a little bit of light on how we look at how currencies trade. I think one of the things that you can say in general is there's the big difference between how currencies trade and other asset classes trade is I think sometimes because there's so much information and there's so much potential information about currencies, yet there really is no one key ingredient or a couple key ingredients that you can find in your stock analysis or bond analysis where you can define real cash flow, real earnings per share. You can look at management quality. You can look at balance sheets and income statements. It's a lot harder to do that with currencies, and because of that, currencies get into trends and they get into self-reinforcing trends based on all different kinds of rationales. So the point is they tend to be a lot more sentiment-driven. At times it's a good thing, at times it's not. It means in general when something is more sentiment-driven as an asset class, they tend to overshoot on the high side and overshoot on the low side. They just overshoot their fundamentals both ways. If you're riding the trend, it's a great thing. But if you're trying to peck against that trend and saying this is overvalued, it can keep running because of the sentiment. So that is, I think, one of the key underlying differences in the way currencies trade relative to the other asset classes. But other than that, you have to do your homework and be disciplined from that standpoint. Anything that you've learned in stocks or bonds or any other futures trading, I think, carries over and applies to looking at currencies. We put together this kind of pictorial as to why we thought, and we did this back in December, and we think it still applies, why we thought it made sense for the powers that be in the world, the policymakers, of all the big boys, why it made sense for the dollar to start to rally and rally. We thought it really did. A strong dollar would have gone, and I think still can go a long way in rebalancing this global economy and not putting us back in the soup where we were before. And that's why we put together these four kind of dynamics, and I'll get to the five major themes that follows, and then we'll go through each of those five major themes, hopefully fairly quickly. U.S. dollar here in the center. First of all, and I guess the thing you know about is the pressure going on in Europe. If we start at the top there, let me grab the pen. Let me get a color we can see. I can't see that one either. Let's try this. There we go. All right. Euro pressure right here. Everybody knows what's going on in the Eurozone. The reality is, to take some pressure off the entire Eurozone, they want a weaker euro. The weaker euro helps Germany export. German exports really help the zone. Germany has to survive and thrive in order for the European monetary system to stay afloat. They are the glue holding it all together. The other countries within the zone need currency relief. They can't get it when they're stuck with the euro. They have no control of their own monetary policy, and the strong euro tends to hurt them in a big way. I mean, they're worse off, obviously, and I won't go into all the Eurozone situations, but they're a lot worse off than Germany. Germany is the paymaster. If Germany can't export in a world where global demand is already weak, then the Eurozone itself is in big trouble, because Germany will sooner or later pull the plug because it will become just politically unviable for German policymakers to remain in the system if they're in trouble themselves trying to save this system. They're already taxing, German taxpayers are already paying a bundle. So a lower euro goes a long way to relieving pressure for all the countries, but also goes a long way, I think, in making sure Germany stays solvent from a trade standpoint and keeps the music playing. So that's one important reason why we think the U.S. dollar, rising U.S. dollar, makes sense there. In terms of the real economy here, number two, the real economy in the U.S. Really needs to get some juice, and part of the problem that we saw, at least we have laid out before in some of our analysis, is the fact that with interest rates so low, this zero interest rate policy, money is just not getting into the real economy. This is a bit of an esoteric point, but the reality is if we had higher short-term interest rates in the U.S. money market or LIBOR in London, you would see a lot more interbank movement of money in the interbank markets. There are some smaller banks out there that have lending opportunities, but because the interbank market rates are so low, where banks lend these reserves back and forth to one another, there's no reason for banks to take a risk and lend this money out. if those rates were higher, we think it'd go a long way in getting money into the real economy. And we thought from a policy standpoint the Fed would start recognizing that. They haven't recognized that, and unfortunately maybe going in reverse. And here is one area in which part of our view is getting into a little trouble. We're running into a little bit of headway, and I'll get into more of that.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.